12% dividend yield, production doubled in just 2 years, and free cash flow expected to exceed $2 billion. And a break-even point below $35 per barrel. Sounds great, so today let's take a look at Var Energi, the Norwegian E&E subsidiary that is currently becoming one of the most exciting upstream stocks in Europe. And why, despite all this, not everything that glitters is gold. Welcome back to the Upstream series part 14, and today it's about Var Energi. Var Energi is not a small explorer. It is the second largest oil and gas producer on the Norwegian continental shelf, right behind Equinor. The main shareholder is Eni with around 63%, and the company is publicly listed. Since 2022 and 2025 was an absolute year of transformation. In this video, we'll take a look at that today. What does Var Energi do? What do the numbers look like? And why does the company pay a 12% dividend, and where do the risks lie? As always, data-driven and without a marketing filter. Let's also take a look here at how I am invested. In total, I hold 44 shares. My entry price was €2.97. Currently in the green with 28% and a net dividend of €14.47, which I have already received. If you too, as an investing pro, want to use your fundamental analyses, currently there is a flash sale, 55% off, and with my community discount, an additional 15% on top. That means you would save 70% in total. You can find the affiliate link below in the video description. The 52-week high and low here are between 23 and 40 Norwegian kroner. VH Energy is a pure upstream player, meaning exploration and production of oil and gas. Operationally active on the Norwegian continental shelf, one of the most stable and secure jurisdictions worldwide for oil and gas production. The portfolio includes over 40 production licenses. The core fields are Balder, Ringhorn, Johan Castberg, Goliath, and numerous stakes in major fields such as Johan Sverdrup. What makes 2025 special is that 9 projects were ramped up. This added around 180,000 barrels of oil equivalent per day at peak production. Total production in Q4 2025 was 397,000 barrels of oil equivalent per day, 1,000 per day. And that is a doubling within just 2 years. According to company statements, the guidance for 2026 is between 390,000 and 410,000 per day. The long-term target here is to maintain over 400,000, at least until 2030. Now let's look at the hard numbers for the 2025 fiscal year. Revenue was $8.1 billion, with EBITDA at $6.3 billion. That is an EBITDA margin of over 77%, which is typical for upstream, but also strong by Norwegian standards. The net profit of $846 million may sound low at first compared to EBITDA. The reason: Norway taxes oil and gas production with a special tax rate of 78%, and that massively reduces net profit. But, and this is important, the operating cash flow after taxes was significantly higher. In Q4 alone, the CFFO was $1,285,000. So, despite the high tax burden, the company generates enormous cash flows. As a result, with a forward P/E ratio of 12.7, the stock does not appear as cheap as some UK E and P stocks. But that's misleading. Norwegian companies are traded at a premium due to their stability and ESG compatibility. And now for the highlight for dividend hunters. Var Energi currently pays 4.89 Norwegian kroner per share annually. At a share price of 41 Norwegian kroner, this results in a dividend yield of just under 12%. The payouts are advantageously made in roughly equal amounts each time, 1.2 Norwegian kroner per share. The total payout since 2025 amounted to $1.2 billion. The dividend policy, 25 to 30% of the operating cash flow after taxes over the cycle. That sounds conservative, but the absolute amount is remarkable. A warning, the payout ratio in relation to net profit is 159%. This means that more is being paid out than is actually earned net. But, and this is the key, the free cash flow covers the dividend. In Q4 alone, free cash flow was $497 million, and the quarterly dividend was $300 million. That's about a 60% free cash flow payout. My assessment, the dividend is solid. It is covered by cash flow, but dependent on the oil price. If Brent falls below $60, things get tight. Currently at over $70, there is a buffer. My yield on cost is currently at 16%, and that is an absolutely top return on the entry price. Clearly above the 8% quality threshold that I set for myself. What sets Var Energi apart from many upstream stocks is organic growth. While Equinor, BP, or Shell are seeing their production stagnate or even decline, Var Energi has doubled its production in 2 years. The key, 9 projects were ramped up in 2025, including soon the X, the largest redevelopment project on the Norwegian shelf. In addition, there's Johan Castberg in the Barents Sea, one of the northernmost offshore oil fields in the world. The project quality is strong. Break-even is close to $30 per barrel. The projects sanctioned in 2025 and 10 new sanctions in 2025 have added around 160 million barrels of 2P reserves. For 2026, the company expects over $2 billion in free cash flow. That would be a free cash flow yield of over 20% based on the current market capitalization. As a result, if the guidance is met, the stock is extremely cheap on a free cash flow basis. Now let's move on to the risks. First, we have the dependency on oil prices. Var Energi is a pure upstream producer without refinery or gas station operations. If Brent falls to $50, free cash flow drops significantly and the dividend would be at risk. Their own long-term assumption is $75. Currently, we are above $70. 2. Norwegian special taxation of 78% tax rate on oil and gas income. This is one of the highest in the world. However, there are generous tax deductions for investments, but that only helps in years with high capital expenditures. When the investment phase is over and capex decreases, the effective tax burden rises. Third, the E&I control. Eni holds around 63% of the shares. On the one hand, this provides stability. On the other hand, Eni could at any time siphon off profits through intra-group transactions or force a delisting. Minority shareholders have little leverage, and that is a structural risk. Additionally, Q4 2025 net profit was only $25 million despite strong CFFO. This points to high depreciation or one-off effects. And that's something you should keep an eye on. So, what is the current assessment? Buy for dividend investors with oil price tolerance? Reason: Var Energi offers a rare combination of high growth and high dividends in the upstream sector. Production has doubled. Free cash flow is expected to more than double to over $2 billion in 2026. The break-even is low, and the Norwegian jurisdiction offers maximum operational security. The 12% dividend yield is the entry point. Anyone who can't handle oil price volatility or sees any controllers as deal breakers should be cautious here. If this analysis helped you, then please feel free to leave a like and subscribe to this channel for more Upstream content. You can also check out the dividend and cost calculator at Mamie. Take a look at mbcsstrategies.com and calculate your own dividend. You can find the link in the pinned comment. And as always, this is not investment advice. Do your own research. See you in the next video. I wish you all successful investing.